a homework assignment on the historical analysis of financial statements, and I also put in a bonus extra credit exercise. So just a little context, and you can again get lecture note 4 is available in Elms. But we have been, first part of the class, talking about the EIC, and the whole point of the EIC was to understand basically what is that external environment, how does it affect the companies that we're evaluating, the economic impact, the industry impact, which is about half the performance, and what was an attractive industry. Some industries better than others, 5 forces today, tomorrow. We also talked about competitive advantage being transient, nothing lasts forever, and how to do all that analysis and assignments. Now that we're moving into the second stage of the class, we talked about how to convert the economic statements. And so as part of this, we're now going to get into how to analyze the converted statements, which is what we're going to focus on today. But before we do, I also want to mention that for homework 5, which is due on Monday, you're going to do the converted statements. But there's also the opportunity to do the first official extra credit. So I'll call it the operating ROIC extra credit. So if you look in the assignments tab and scroll down here at the bottom, there are 2 things under the extra credit. One is called the assignment replacement, so that's now officially live. So again, at any point during the semester, if you screw up one of your individual assignments, you can take the assignment replacement. It's 500-word paper. Make sure you write at minimum 500 words. So you write 498 words, you still get no credit. Okay, and it's got to be about the topic that I've given you. But basically, if you write it by the deadline, which is December 2nd, then at the end of the semester on December 3rd, the TAs will look across your grades, take the lowest grade, replace it with a perfect score, and it won't count, that individual assignment won't count against your ability to opt out of the final exam. Okay? So for those of you that were asking about the assignment replacement, that's where it is. We're not going to grade it until the end of the semester, so you don't have to even worry about when you do it, as long as if you want to do it, you do it by December 2nd. The other extra credit, which is now available, due Monday, is for operating ROIC. When I was introducing the historical statements, I showed you how the ROIC and the operating ROIC could be different, and I told you that you didn't have operating ROIC in your Bloomberg terminals. Well, this assignment is to put the operating ROIC in your Bloomberg terminals. It's extra credit right now, but eventually you're going to have to do it for future assignments, so you might as well take advantage of the extra credit. It's 1 point if you get it correct. So the way the assignment is going to work is click on here. These are the custom formulas that you will need to build in Bloomberg in order to create operating ROIC. Okay, so in Bloomberg, they have all their standard fields. They're called Bloomberg fields. But Bloomberg, as you guys all know, because you have now been certified, allows you to create your own custom fields. They are individual to your account, but you can create custom fields. Now in Bloomberg, there are only 2 sections that they allow you to create custom fields. Right? One section is RV, the other section's EQS. Those are the only 2 areas you can create custom fields. You cannot create custom fields in FA, inexplicably. I don't know why they won't let you, but they won't. I've always asked them why not. They're like, just do it in Excel. Okay? But basically, EQS, FA, which practically means you can't do custom fields on historical data. You can only do custom fields on current data. That's essentially their limitations. Right? But regardless, unless you specifically go through some of the machinations which we'll talk about, they make it hard to do it on historical data, is more likely, is a better way to say that. But for your assignment, it's going to be on Starbucks. So you go to Starbucks US Equity. And then you'll go to RV. It's the simplest way to do this. And when you get to RV, you'll go to custom. And the way that you create a custom field, and by the way, since we're all doing it the same way, best fit algorithm, restaurants, country of domicile. Click on this little gear icon, and you'll see on the gear icon it says add formula. A formula is a custom field. That's where you're going to do that. So on the left will be all the custom fields that you have historically created, which for you is probably blank. Okay? But it will save them individual to your account. So my custom fields are not seen by anybody else. They're only seen by me. Okay? But nonetheless, I can use a combination of standard fields or previously created custom fields to create formulas. And I can create custom on custom if I want. Right? So that's what we're going to do here today. So we need to create an operating ROIC. So the way that you do this is in this big blocks, you can actually type in the code, but the simple way to do it is you start typing in your fields and it will help you build the actual equation down here, okay? So let's just say the first one we got to create is, to get to operating ROIC, we need a custom field for NOPLAT as we define it. And NOPLAT as we define it is operating income times 1 minus the effective tax rate. Now, just so we all are looking at it the same way, the time period is going to be very important. So this is NOPLAT of the latest fiscal year, not the latest filing, okay? So if you put the latest filing, you get the wrong answer for this assignment, okay? So here's how it would work. So what I need to do is I'll go back to Bloomberg, and so for the field, I need my latest operating income or loss. So I'll start the formula, left paren, operating income or loss. It'll show it to me. These are the Bloomberg fields. This is the Bloomberg field I want. I'll click on it, and it says, what period do you want? So the one that I want is for the latest year, okay? Not the latest filing, right? Because the latest filing would be a quarterly filing. The latest year is the annual filing. So we want annualized data. We're going to do it based on the latest annual year from the latest 10K. So latest filing, it's the latest year. So what it will do is when you hit enter, it'll stick the formula field down here. This is the actual database field. String IS 033, colon, Y for latest year. Okay? So every time you open it up, Bloomberg will go get that field at that level of period and display it and get that number. Okay? So you don't have to know that unfriendly database name. You can put in and tie the friendly name. But I want to caution you because Bloomberg's been around for a while. And so they actually have several things that point to the same cell. Okay, so you might see different friendly names that go to this cell in their database. But that cell will never change regardless of the friendly name. So for example, in the European statements, they might call sales turnover. Okay, in the US, they might call it sales or revenue. Right? Even though it's the same system, they should call it sales, revenue, turnover, but they don't. So therefore, if you see turnover, it's actually revenue, but how do I know? Well, what's important is Bloomberg will always point to the actual same database field, no matter what they call it, in different parts of their system. That's just something you're going to start to stumble across that gets a little confusing sometimes. That's why it's important to get the right database field. You may not know it, but at least for this assignment, we're going to use the same fields. So I got this field, period, colon Y, then following, end parentheses. You probably don't need to end the parentheses here, but you could, times for order operations, left paren, then 1 minus, left paren, the effective tax rate. So again, go back to field, effective tax rate. And again, as of the latest year, hit enter. Then I want to divide that by 100, right paren. When I'm ready, I can either save or I'll hit save and use. Boom, it'll ask me to name it. I can name it up to 11 characters. So this is my NOPLAT. What is this? What section is this? 301? 201? 2 p.m. 2 p.m. 19. Okay. Can't remember your section number. The numbers just screw me up. All right, so I'm going to hit name. And then boom, there it is. For Starbucks, 3.04 billion. Okay, so you should have that number. Now, when I start creating my next field, if I type in NOPLAT, you'll see, what do we call this? NOPLAT 2 p.m. 19, which is what I just called it, is now in my database. So I could then use it to then divide by whatever or multiply by whatever. So I can actually build these custom fields. And what you'll notice is your custom fields are now labeled custom field, where the Bloomberg fields, show more matches, were labeled, actually it won't be in the search results there. If I go back to NOPAT, would be labeled Bloomberg field. And again, they're going to be in the database for searching. You can find these custom fields either EQS or in RV once you create them. Yes?
It works fine to use your own fields in further formulas for fields.
Exactly, because that's what you're going to do. You're going to calculate an OPLAT. You're going to calculate an operating working capital. You're then going to calculate an invested capital, operating invested capital, and then you're going to do R NOPLAT divided by that operating invested capital, and that's going to be your operating ROIC. Right? So to get the solution, you're going to have to do that. And to know that you have the right answer, what you're actually going to submit is operating ROIC for Monday as a custom field. Once you finish all the custom fields and put them all in, with this template, 37.08% for, or 37 point, was that 08, I think it's for Starbucks, and 38.8 is the industry average. So that's what the TAs are going to be looking for, as well as a WACC of approximately, this one could change, but the WACC should be around 7 for Starbucks and 6.5. The WACC might be slightly different, but the way you're going to be graded is the 3708 and the 3884 for the industry. So those are the numbers you have to get the extra credit point. All right. And again, I am going to ask the TAs to be a little ticky-tack because I want you to actually have the formulas, the same formulas that I do when we look at operating ROIC. And then here's what's going to happen. To this point in the semester, when we did industry attractiveness, we did Bloomberg ROIC as a industry attractiveness spread. Going forward, we're going to use operating ROIC to determine industry attractiveness, right? So that's what we're going to use going forward when we do EIC. Once you have this in your system, you'll be able to quickly to do it for all of these industries. Okay? Questions? Okay. So that is extra credit 1, due Monday, 10 a.m. No write-up, just submit a screenshot. Okay. Now, let's talk about homework 5, which does involve a 500-word paper, minimum. So it's going to be the historical analysis. So go back to PowerPoint, and again, I had put up lecture note 4. Okay, so I'm going to start with 2 historical statements that we're going to analyze. All right. The first, we'll use McDonald's as our working example, is we're going to build out something called an ROIC tree. And you can see the ROIC tree here on the screen, 5 years of historical ROIC. A little bit bigger. And what you're going to do is you're going to explain the change in ROIC, and there will be 3 drivers that always explain ROIC changes for every company every time. Okay, just math, but that's the point. What is the ROIC? Why did it change? Right? So we'll start out with the 5 years. Well, the training wheels are on, and this is your first assignment. You're just going to do year 1 and year 5 and the overall change. However, as you move through the semester, the training wheels come off. You're responsible for the overall change throughout the 5 years. All right? But for now, I'm going to keep it simple, beginning and end, as you get started. So, what do I mean by that? EOY stands for end of year ROIC. That's right here. Okay? So, there's a little bit bigger than I wanted. Well, figure out how to, what the pencil, not the pen. There we go. All right, so in 2010, the ROIC of McDonald's historically was 21.8%. In 2014, the ROIC of McDonald's was 18.9%. That is, so use the highlighter here, 18.9%. That is a 13.6% 5-year change down. Okay? So what I'm trying to explain is if I made 21.8% of after-tax cash profit per dollar of investment in 2010, and it fell to 18.9%, or about 19% of after-tax profit per dollar of investment in 2014, Why did it go down by 13.6%? There are 3 reasons it could have changed, and we're going to talk about all 3. Number 1, what is the cash tax rate? That's number 1. Number 2, what is the operating margin? And number 3, what is the productivity or efficiency of the business? That's supposed to be a 3. Okay, those are the 3 drivers. All right, and mathematically, those are the ones that explain the change in ROIC. Let's start with the first one, which is the tax rate. In 2010, their tax rate was 29.3%. In 2014, they paid taxes at a rate of 35.5%. Because they're paying taxes at a higher rate, that will hurt their after-tax ROIC. So one reason why the after-tax ROIC end of year went from 21.8 to 18.9 is because the tax rate went from 29.3 to 35.5. So that 6 percentage point rise in the tax rate, or the 21% rise in the tax rate, was one of the reasons why their ROIC went down. And note, I am using numbers when I explain this. I don't care if you write 3,000 words on this assignment, no numbers, no credit, no matter whether it's right or wrong. Must use numbers. Okay? So, given that driver, I'm then left with a pre-tax ROIC of going from 30.9 to 29.2. So, if I think about the core business, which is the pre-tax ROIC, it also worsened. So, it wasn't just the higher taxes that led to the decline in ROIC for Starbucks. Their core business actually got a little worse. The pre-tax ROIC also declined by 5.4%. So, why did the core business pre-tax ROIC decline by 5.4%? Drivers 2 and 3. So, try this with a slightly smaller pen. Go back to the pencil. So, theoretically, if this works, draw it down here. Profit divided by sales is this. That's this. That's profit over sales. Okay, that's margin. How much profit, how much operating profit divided by sales revenue. Okay, times sales divided by investments, which is this, equals profit divided by investment or invested capital. That's ROI. Profit divided by invested capital is ROI. Okay? And what this simple algebraic equation tells me, this multiplication sign, there are 2 drivers that have equal weight. One is profitability, profit divided by sales, times productivity or efficiency, sales over investment, equals ROIC, profit over investment. Okay? So algebra tells me these 2 things multiplied together equals this. And both of those things have equal weights. Right? Now the difference is, this is investment over sales, and that is sales over investment. So for purposes of this tree, I have taken the reciprocal. I divided by S. And the reason why is because in the real world, companies tend to think about things in terms of sales. How much profit did I make when I sold something? How much do I need to spend to sell more stuff? So just to be consistent, I just put the denominator in sales. So technically, operating margin times 1 over this is pre-tax ROIC. I just did the reciprocal, right? But basically, these 2 things have equal weight. So let's explain, using that, why the pre-tax ROIC is dropping, right? So the first thing is the operating margin. In 2010, McDonald's operating margin was 31%, operating profit divided by sales. In 2014, it fell to 29%, a 6.7% decline. So basically, their operating margin went down by 2 percentage points. That hurt the pre-tax ROIC. Productivity, invested capital to sales. In 2010, to generate $1 of sales, McDonald's invested $1 of capital. In 2014, to sell $1 of sales, McDonald's invests 99 cents of capital. Is that better or worse? It's actually better. I am 1 cent better to sell the same stuff. So I'm not basically spending as much to sell the same amount. I got a slightly smaller balance sheet relative to my sales. So that's an improvement in productivity, which should help my ROIC. So as I think through the three drivers, McDonald's ROIC went down over 5 years from 21.8 to 18.9 because, number one, the tax rate went up by 21% from 29.3 to 35.5. But that was, and their margin went down from 31 to 29, which hurt them. 2 points decline in margin. Hope I said that right earlier in the video. And invested capital to sales actually slightly improved by a penny, but that wasn't enough of an improvement to help their overall ROIC, pre-tax ROIC and the after-tax ROIC. Does everybody see that story I'm putting together for those three drivers? Because that's what I need you to be able to explain. That's what's called the first level of analysis. Always three drivers, every time, every company. Okay? Then you're going to do what I call the second level analysis. Now we're going to go over here and say, okay, what's driving the operating margin? Well, that is going to be the income statement. Okay? And there's three parts of the income statement that drive operating margin. Gross margin or gross profit margin, SG&A, and depreciation. Now, if I have to take my gross margin, subtract my SG&A, subtract my depreciation, I get my operating margin. So this minus that is this. Okay? All right. So let's explain, how did I lose 2 cents per dollar of operating margin? Well, my gross margin was 45% in 2010. 2014, it was 61%. Big jump. SG&A went from 9 cents to 26 cents. Big jump. Depreciation went from 5 cents to 6 cents. Little jump. But overall, seems like a big jump for McDonald's over the 5-year period of time. So I know we're just doing the beginning and the end, but let me look at the middle. So let's look at gross margin. 45, 45, 62, 62, 61. Let's look at SG&A. 9, 8, 25, 25, 26. All right, something seems odd between 2011 and 2012 about McDonald's. Something dramatically changed, right? From what I know in the real world, it's not like they completely got acquired by somebody or did some gigantic acquisition, right? They still sell burgers. So at the end of the day, something's going on. Well, basically what happened is the accountants changed how they classify costs. And they took stuff that previously was in cost of goods sold and they moved it into SG&A. Now, when you net it out, you still get about the same operating margin, but unfortunately, it makes comparing 2010 and 2014 far more difficult. So here's where you got to put your common sense on. What we really can compare, like versus like, is 2012 to 2014. And if I look at the operating margin, it was really between 13 and 14 when it dropped. So that's probably the more telling part of what's going on at McDonald's anyways. So like versus like, 2012 gross margin 61.7, 2014 61.4. Basically stayed about the same. Still making about 61 cents after they sell their food. SG&A went from 25 to 26.5. So basically, they're spending about 1.5 cents more, 1.4 cents more per dollar of SG&A, sales, general, administrative, marketing, to get you to come to the store. Depreciation went from 5.4 to 6. So they're spending about another 0.5 cent, 0.6 cents more on the actual store depreciation. So if I really want to understand what drove down the operating margin, it was the increased spending on SG&A and the less efficient use of depreciation for their business. Going to the second level drivers of the balance sheet. When we created operating invested capital, it was three things. It was working capital, It was PP&E and goodwill as the big ones. All right, so that's what we have here. So OpWC, operating working capital. What happened between 2010 and 2014? Well, in 2010, they had negative 2 cents of operating working capital to sales. In 2000, it was basically zero. So they went from negative 2 cents to zero, which means they spent incrementally 2 cents more on working capital. That's going to hurt their productivity and hurt their ROIC, spending more to sell the same stuff. Now, somebody in the previous class said, what does it mean to have negative working capital? It means you have more liabilities than assets. Okay? Basically, McDonald's is taking a while to pay their bills. They're leveraging their suppliers. Right? They just leveraged them less in 2014. PP&E, property, plant, and equipment to sales. That's the restaurants. 2010, 91.6 cents spent on PP&E. 2014, 89.5 cents. Well, that's the productivity benefit. They're now spending essentially, call that 3 cents of 3 cents of, was it 2? 2 cents less of PP&E per dollar of sales, going 91.6 to 89.5. Intangibles, that's the purchased, shows M&A, went from 10.7 to 10. So intangibles are not going up, so we know they didn't do acquisitions, right? And they either wrote off something out a little bit more efficient, but the point is, no real acquisition activity here. So for McDonald's, why did the productivity improve? Basically, the improvement in intangibles and PP&E offset the worsening of the working capital. Now, we've done the first level, we've done the second level, time for bottoms up. We do the first walk by going top down, starting at ROIC, walking through the 3 drivers, walking through the secondary drivers of income statement and balance sheet. Now, we start with the secondary drivers and we tell you what was really impactful. What's the real story of McDonald's? For McDonald's, it was the increase in SG&A of approximately 2 cents, 10.5, and the slight improvement in invested capital sales, primarily driven by the PP&E to sales, but that was not enough to offset that margin hit of SG&A, which caused the decline in operating margin, which declined the pre-tax ROIC in combination with a slightly higher tax rate, which led to the overall decline in ROIC of McDonald's. So we walk down, we summarize key drivers up. 250 words right there. Should be easy to write. That's half your assignment. Using numbers along the way. Let's do this again with Chipotle. So the next slide, this is pre-E. coli Chipotle. So before they decided to try and kill everybody, they were doing pretty well. All right, so 2010, 2014, same period as Mickey D's. Level 1, end of year ROIC. 2010, 26.6% after tax end of year ROIC. 2014, 40.8, a 53% increase in ROIC. This was the good old days for Chipotle. Tax rate. Tax rate in 2010 went from 38 to 37.6, so a slight decline in tax rate of 1.1% would have helped their end of year ROIC, but really for Chipotle, it was the pre-tax ROIC going from 43 to 65.5. That was the primary driver of the after-tax ROIC going up. Okay? Now, as we look at the pre-tax ROIC, what was driving that? Well, their operating margin went from 15.7 to 17.3 over the 5-year period, a 10.4% increase in ROIC. So basically, for Chipotle, they were actually making more on their products while paying less taxes. And we go to the third driver. In 2010, they were spending 36.5 cents of investment per dollar of sales. 2014, 26 cents to drive the same dollar of sales. They were getting more efficient. All 3 drivers were favorable for Chipotle. They were paying less taxes, they were getting more profits on the same goods, and they were being more productive and efficient as they grew. This is why investors at the time loved Chipotle. And interestingly, at the same period of time, this is when McDonald's was starting to struggle. So what this also tells me is this wasn't an industry issue at McDonald's. This was a McDonald's issue at McDonald's because Chipotle, selling to similar customers, was actually doing extraordinarily well. Okay, and we can see that as we do this competitive and peer analysis. Okay, questions about that? Which leads to the second level analysis. Why did the operating margin for Chipotle go up from 15.7 to 17.3? Well, if we look at our gross margin, went from 30.4 to 29.9. So they lost about a half a cent in gross margin. But their SG&As went from 11 cents to 9.9. So they picked up a penny by being efficient with their SG&A, and depreciation as a percentage of sales went from 3.8 to 2.7. So they picked up another 0.8 cents in depreciation. So it was really the improvements in SG&A and depreciation which offset the slight decline in gross margin that led to the increase in operating margin. If I look at my invested capital sales by productivity efficiency, why did they get much more efficient? Because the 27.5% drop in how much they had to invest to sell things is an improvement in productivity. So how did they do that? Well, they went from spending negative 1.6 cents in working capital to negative 1 cent on working capital. So like McDonald's, they put more money into working capital. Even though it's negative, it's less negative, which means incrementally they're spending more. But if I look at store productivity, PP&E to sales went from 36.9 to 26.9. They're spending 10 cents per dollar less to generate revenue on their stores. That's a big improvement in investment, freeing up 10 cents per dollar of cash, right? And intangibles went from 1 cent to half a cent. They basically aren't doing acquisitions, pretty flat. So essentially, all of the productivity improvement, invested capital sales, came from PP&E to sales, which is ironic because this is the time period where Chipotle was opening up stores left and right, and they were growing like a weed, right? And so what was interesting is usually when companies are growing, you don't expect a dramatic decline in PP&E relative to sales. You'd actually probably expect the opposite. I got to open up stores before people show up. But if you remember, in the good old days for Chipotle, they'd have lines around the block. They'd open the stores, they'd be filled. And they didn't have to tell people too much when the store came to show up. They'd open the store and people would just show up. So they weren't spending a lot at SG&A. And you could see this in their financial statements. So this was when Chipotle was firing on all cylinders because basically they were growing very fast. They were being efficient with their growth, right? And basically they're getting a lot of revenue as they were opening their stores. They were getting better margins as they were opening their stores because they weren't having to spend a lot on SG&A. And at the same time, they're paying less taxes. So they were winning on all three, and that is why they dramatically increased their ROIC over the 5 years. Questions about that? Yes?
So for the homework, you want us to make this Excel and then also explain why they're right.
The good news for you is you don't have to create the Excel. For the homework, I'm going to give you the chart. So you don't have to build the chart, you're going to get the chart. But everything else he said is correct. So you're going to have to do the same explanation that I did, the same chart walk. So this is the ROIC tree. We're going to be using this a lot this semester. As I said, this is the second core part of our analysis, and this is how we analyze things once we have put things into an economic format. So you're going to have a lot of practice over the semester doing this. But it also, and I hope I started giving you some insight here, this is, in my opinion, the payoff of the hard work that you did on the conversion statements. Because once statements are converted, it actually gives you a much cleaner line into understanding what's actually going on at the front. Okay? And that's one of the things you're going to quickly find as we start going through this type of analysis. So I hand over there? Yeah.
So like the PP&E divided by sales, are you saying basically that like their total PP&E must have still increased, but their sales were so much bigger that the ratios went down?
Exactly. So think of it this way. I have $1 of PP&E for $1 of sales. Okay? But going forward, I get another $1 of sales but I only spend 50 cents on PP&E. So what I'm doing is I'm spending less on facilities. I'm getting a lot more customers, a lot more sales. And so what I'm just saying is practically what was happening at Chipotle is just they were getting so many customers at every restaurant. And they were as busy as your average Chick-fil-A drive-through or your average In-N-Out burger, right? And so that's the benefit, is just they were just packed constantly. So they weren't trying to fill the stores because customers were just there and they were just trying to meet customer demand. Now that's unique. A lot of retailers don't have that luxury. And by the way, today, post E. coli scare, they never got back to that level. Like, try going to Chipotle at lunchtime 5 years ago. Good luck. Today, you're probably like first in line. Like, there's hardly anybody there. And they never really recovered after their bad E. coli scare, but this is the kind of pre-E. coli Chipotle. But that's why investors love them, because they were growing and everything was going and firing on all cylinders financially while growing. Because you threw growth on top of this. Yeah.
If they didn't have the equals there, do you think they would have slowed down just like a lesser rate?
Everybody slows down eventually. Nothing lasts forever. That's the other thing you should learn from the McKinsey book, is you will see regression towards the mean. You will see competitive advantage is transient and doesn't last forever. So no matter what it was, it would have slowed down, but it wouldn't have slowed down as dramatically and not as quickly. No different than what Netflix is going through today. Netflix is starting to slow. There's nothing against Netflix. It's just, look at how much competition's out there. Look at how many choices we have. Look at how much we're spending. And the fact that they already have hundreds of millions of customers. How do you get hundreds of millions of more customers? There's not just that many people in the world that can actually get your subscription. So eventually you slow down. Okay. All right. So here's your chance to practice. This is not for a grade. You're just here in class. But it's what you're going to do for a grade. Here's company number 3. And I'm not going to tell you who the company is. So take a second. You're welcome to talk to somebody next to you if you want. Do your own little practice walkthrough. And then we'll talk about it in a couple minutes. Okay? So I'm not going to tell you who the company is because I don't want to bias you. And by the way, notice the time period is through 2018. So this is one more current. It's real data. That's a real world company. If the company doesn't matter, I want you to do the analytics. So see if you can do your own practice walkthrough individually. And I'll talk about it in a few minutes.
Is this in the slide? Is this chart in the slide?
Is what?
Is this chart in the slide?
Yeah, lecture note 4.
Yeah.
Yeah, if you go up to lecture 4, that PowerPoint or PDF is actually these slides. Yeah.
Probably have Chipotle. I get it all. Cheap and yeah. It's quality. Jump in the tax rate.
Oh, they jumped from 2016
It
to
was a big
2017.
jump, but yeah.
Yeah, exactly. That's why.
So it was both back.
Yeah.
One was pulling it down. No, they both work in together. But like, yeah.
They were less efficient with their domestic sales, but they were a lot more negative on their operating margin, which outweighs the inefficiency of the business. So those two Wait, what's with this negative? Is this like another? Oh, it's just because it's
Is this another what?
a food company.
It doesn't matter what.
Okay, we're just thinking like it's like
We're trying to guess it.
we're trying to guess.
It's not. It's 4 years later, so I don't know what to say. It could be. It could be. But it's not the same period. Just be careful. And by the way, I appreciate what that team is doing. They're trying to guess the company, and they're trying to look for patterns. But when you do this, I want you to look at it just right now. Just look at the company itself. Look at it independently of the others, just while you're learning. But eventually, I like the idea of looking for patterns across companies, but don't try to do that yet.
Well, that's just like where did
Horizontal. Yeah.
All right. I know I didn't give you too much time, but let's at least start the process here. So as we're doing the walk, what can we say about the end of year ROIC for this random company for the first 5 years? So between 14 and 18, what can we say? Yeah. I'm sorry?
It went up by 30
From...
From
Yeah, and again, I'm going to be a stickler because I want you to keep using numbers when you do it. Don't just give me the percentage change. Use numbers. Okay, so exactly right. So why do that first? Start the first level. So keep going. You're doing well. What about tax rate?
The tax rate went down from 35.5 to 24.2%.
So that help or hurt the after-tax ROIC?
It helped.
So one of the reasons why the after-tax went up because the tax rate went down. What about the underlying business, the pre-tax? Keep going.
It went up from 29.2 to 34.
So is the tax rate the only reason why the end of year went up? No, obviously the business itself was improving. Right? So that's great. That's exactly how we should be starting it. She did a great job kicking us off. So now let's keep going. All right, we know the pre-tax went from, as you just said, 29.2 to 34.2, a 70% increase. Now let's look at the second and third driver. Okay, let's look at margin, productivity. What about the margin for this company, operating margin? Did that help or hurt the pre-tax ROIC? Help or hurt? Okay, it went up from what? 0.42. Yeah, that really helped. It was a big jump in margin. They're making a lot more margins. Like I said, they're making 44 cents per dollar profit versus 29 cents per dollar profit. That's a big jump in profitability over 5 years. Okay, what about the productivity? Invested capital sales. Did that help or hurt the pre-tax ROIC? Yeah.
It would significantly hurt because it took 99 cents per dollar of sales, and then that ultimately increased to is at 1.22.
Yeah, 1.227.
Which means that they're a lot less efficient with their invested capital.
Yeah, because they're spending almost 23 cents or so, 23, 24 cents more of capital to sell the same stuff. So unlike Chipotle, which was improving margins and improving store productivity, this company is improving margins, but they're investing a lot more in their business while they're improving margins. However, the 44.9% improvement in margins more than offset the 24% worsening in productivity, allowing the overall pre-tax ROIC to go up by 17%. We can draw that conclusion. Everybody see how I did that? Great. Now let's get into the second level analysis. Why did the operating margin go up by 44.9? What about the income statement changed over the 5 years? Gross margin, SG&A, depreciation. What happened there? Did the gross margin change? Yeah, by 32%. It went from 44 to 58. So whatever they're selling, they're making a lot more money every time they sell whatever product or service they're selling. It's more profitable, better mix. Are they spending more to sell it? What about SG&A? No, 9.1 to 9.3, pretty flat. What about depreciation? 6 to 7, that hurt them? Hurt them by a penny, but not enough to offset the gross margin jump, which was almost, 14 points? So if you really want to look at what was driving operating margin, it was the gross margin. They're making a lot more money on the sales of their products. Now, what about productivity? What worsened their productivity on their balance sheet? Remember, the invested capital is a function of three things. It's working capital plus PP&E plus intangibles and goodwill. So what was it? What happened to working capital? PP&E, that hurt them the most, right? Went from 89.5 to $1.09, 21 cents. But working capital, help or hurt? It went from 0 to essentially 1, if we round off, or 0.3 or 0.003. So a little worse thing, but not much. And intangibles went from 10 to 11. Did they make substantial acquisitions? Not really. Spent a penny on goodwill. So really, it wasn't making a bunch of acquisitions. It wasn't a giant buildup of inventory or anything like that. It was all PP&E. That they spent a lot on stores. But am I worried about that? No, because look at these margins. Heck, keep selling this margin. Open up as many stores as you want. Right? So as I said, now let's work backwards. Why did Starbucks see such a dramatic improvement in their ROIC over these 5 years? This is Starbucks, by the way. What was it? What's the real culprit? Why is it going up so much? Yeah, it's the gross margins. And they open up more stores, productivity, PP&E, but that margin hit and less taxes as they went international with lower tax rates than the U.S. during this period, because before the U.S. cut its rate. International growth. It was driving a better menu. I mean, when you guys spend $6 for the strawberry acai lemonade that probably cost them 30 cents to make, right? Basically, they're cleaning up and they're kind of firing all cylinders, even though they're actually opening stores again. That's why Starbucks is doing well. And that's why investors like them. Yes?
So when you see like gross margin change a lot, is it important to look like the supply chain? What's important to look at?
Well, that's a great question. So if gross margin is changing, it's either more price or less cost. So, or different mix of products that we're selling. So, but that's one question. All right, so what's going on with the supply chain? Are they actually sourcing lower cost coffee? Are they actually getting just less, labor and other costs through their supply chain? It's a great question. And so that's the point. Like, this will lead us to questions that we can at least ask. If we're analysts, we can actually ask it on the conference call to the management, but exactly the type of insight I want you guys to have. So it's a great question. All right. If I had to guess from what I remember reading about Starbucks, what do you think? Do you think it's cost? Do you think Starbucks is driving the cost of their food and coffee down? Or do you think it's price?
They raised prices 2 times in this period.
Yeah, I think it's price. I think they've been just really raising price, and people are not going away. They're still going there, right? And so essentially, I think that's the point. Like, they've been expanding outside the U.S. particularly, and they've been expanding a menu at higher price throughout the day. Now that they're getting into proteins and other stuff, and it's actually been the last few years pretty successful for them. And that's what you're seeing in the ROIC tree. Okay. All right. The other statement you're going to look at is CFI. So just as we're going to do 5 years of ROICs, we're going to do 5 years of CFIs. So let's go back to start with McDonald's, and this is the CFI. So in the CFI, I'm going to give you 5 historical years and then a total. The total is literally that. It's the sum of the 5 years, right? So again, training wheels on. Right now, we'll start with the total. I'm not going to hold you too accountable for this assignment for the middle years, but over time, you're going to have to be responsible for all the trends across all the years. Okay? So essentially, let's start with the total column for the 5 years for Mickey D's. So total, when you analyze the statement, there are 4 sections you got to explain. Always 4 sections. Operating cash flow, non-operating cash flow, debt cash flow, equity cash flow. What happened to each one of those sections? You will also start with free cash flow. Start with the operating free cash flow. And actually, by starting there, here's the key. If free cash flow is positive, it will affect how you analyze the statement. If free cash flow is positive, I'm going to be looking in the other sections to see where the money went. If free cash flow is negative, I'm going to be looking in the other sections to see where the money came from. Okay? Because that's the point about the balancing statements. So first, start with free cash flow, positive or negative and why. Then, how is that cash used or generated based on the other sections? Okay? So let's start out with free cash flow. Over the 5 years, McDonald's generated $23.9 billion of free cash flow. Okay? Now, from the income statement, gross cash flow of $35.5 billion. Gross investment in working capital and CapEx of $11.2 billion, which was a 32% reinvestment rate, leading them to free cash flow before acquisitions of $24.2 billion. Spent about $300 million on goodwill. It's not really a lot of acquisitions, so basically about $24 billion of actual free cash flow. Now, if McDonald's had a reinvestment rate of 32%, 31.7%, what's their payout rate? It's got to be around 68. Okay? So if I'm putting 32 in, I should have 68 to be able to pay out. That's the whole idea. I got $24 billion of free cash flow. How did I distribute that payout rate? Did I actually give it to the investors, or did I do something else with it? That's the whole perspective that we're going to have. But before we leave this section, the other thing I want to do is look a little historically. So what happened to the gross cash flow? 6.5, 7, 7.3, 7.5, 6.7. Little drop between 13 and 14. What happened to gross investment? Reinvestment rate, 34, 29, 49, 34, 11. So what's interesting is that, yeah, they did really well and they averaged 32%, but there was a big decline in 2014 in reinvestment, and there's a big decline in gross cash flow in 2014. So I want to talk about depreciation. So depreciation on the accounting statements is generally straight line with a half-year convention. And the idea is I have a long-term asset and I spread the cost out over its useful life. So building 20 years, equipment 10 years, whatever it is. and I take about a tenth a year for a 10-year life and about a 20th a year, 5%, and depreciate that for a 20-year life. Okay? So here's a rule of thumb in finance. You have to reinvest your depreciation to maintain what you got. Okay? Because the idea is that I have a 10-year asset and I lose a tenth of it a year, I should be reinvesting about a tenth of that a year to kind of keep the asset up to where it needs to be. Okay? I'm kind of treading water by reinvesting my depreciation. So companies that aren't growing should have pretty close CapEx to depreciation ratios. So I'm basically just reinvesting what's wearing out. Now, if I spend a whole lot more CapEx than I'm depreciating, why would I do that? Building a bunch of plants. Why would I build a bunch of plants? Why would a company build a lot of facilities, manufacturing facilities? What would they hope to do? Exactly. So when CapEx is a lot higher than depreciation, what's the signaling effect? I'm going to grow. Does everybody see that? If I'm spending $2 billion on CapEx, I got $1 billion on depreciation. Why am I spending so much building plants? Because I think I'm going to sell more products. Companies are telling me that I think I'm going to grow. If I have $1 billion of depreciation and $1 billion of CapEx, probably not expecting as much growth, so I'm probably selling about what I'm selling. What's going on with McDonald's in 2014? What is their CapEx? In dollars, 2014. $454 million. What's their depreciation? $1.6 billion. I'm depreciating $1.6 billion. I have $455 million of CapEx. What's the signal? Not expecting to grow. In fact, I might even be expecting to shrink. Hindsight's 2020, but if you remember a few years ago, McDonald's had a lot of trouble with growth. They had a lot of trouble with same-store sales. They couldn't get you to come to the stores. People were questioning their menu, and you were seeing it in their numbers. But more importantly, what I'm telling you is McDonald's was telegraphing their problems to the world before it became apparent if you actually looked at their cash flow, because they were slowing down their own expansion after several years before it really was apparent that they were having trouble with the marketplace. So again, this is hindsight being 2020. But what I'm telling you as a smart analyst, you want to start to see at least 12 months out, start looking at what companies are doing their CapEx. Because in a way, that's kind of telling about what they're thinking about growth. I'm not saying it's right or wrong, it's just what they're doing. And then we saw a dramatic slowdown in 2014 in what they were spending. It's probably a reason why they were doing that. Okay? Now, what did they do with their $24 billion of operating free cash flow? Well, they got to 24/7 of CFI. So they basically got about $700, $800 million worth of non-operating cash flow. Where did it come from? Well, excess cash went up by $200 million, so it wasn't from excess cash, but they sold $1 billion worth of non-operating assets, 1,097. So basically, the way they increased their CFI was after putting $188 million in the bank, they sold about $1.1 billion in non-operating assets, giving them approximately $24.8 billion of CFI to distribute. How did they distribute it? Debt, equity. Well, we know they paid out $1.73 billion in interest. Okay, that's a positive number, therefore distribution. What does the negative 4411 of debt tell us? Debt was negative 4411. What does that mean? They paid off the debt? No. Paid off the debt would have been positive 4411. They borrowed $4 billion worth of new debt. Now, I've asked this question several times on the last several final exams or midterms, and most of the time people miss the questions anyways. About a quarter of the class misses it, so I'm not worried. I'll still get a quarter of you aren't paying attention. But I'll just ask a simple question here today. Did McDonald's need to borrow that money? Yes or no? And there's a correct answer to that question. Did McDonald's need to borrow that money?
No.
Why not? How could you say so with certainty?
They paid out $14 billion.
Nope. Unfortunately, Good try. That's not the correct answer. He had half of it right. It was correct. McDonald's did not need to borrow that money. But how can we say that definitively? Yes.
Because they had positive free cash flow?
Yeah, they had $24 billion of free cash flow and $24 billion of CFI. They don't need to borrow $4 billion of debt. They generated $24 billion more cash than they spent. They fully funded their operations. So why is this discretionary debt being borrowed? I'm going to ask you to hold that as a rhetorical question for 30 seconds. Let's continue. What did they then do? They paid out $14 billion worth of dividends, and they repurchased $13.6 billion worth of common stock. What's 14 plus 14? Plus 1.8. 29-ish. What's the difference between 29 and 25? There's the debt. What we can see very clearly is the McDonald's borrowed the debt to buy back the stock. Right? I'm not faulting them for that. I'm just telling you that's what happened. Matter of fact, a lot of companies were doing this. We're now at all-time low interest rates. Why not take advantage of cheap debt markets and reward our shareholders? Why not, when my business conditions actually deteriorating, buy back the stock to improve my EPS that aren't actually growing when I'm the CEO and I'm basically rewarded on growing EPS and a higher stock price? And people aren't buying my stock because my business is getting better. I could see that in the ROIC tree declining. I can see my cash flow going down. I'm not opening up any stores, so I'm going to buy back the share count and improve my earnings that aren't actually going up by getting rid of stock. And that creates short-term liquidity in the stock market, which actually drives the stock price up. That's why they bought back the stock, but I don't say that publicly. I say I'm investing in the future of McDonald's because I believe in this company. Here's $30 billion. Okay, sounds all good, but nonetheless, if you're a smart analyst, you see be right through that smokescreen, and you'll take the $30 billion to the bank, but I'm not going to buy more McDonald's stock with that because I see some troubling things that are going on with their business and the actual analytics. This is why we do this type of analysis. And I'm telling you, a lot of traditional financial statement ratios miss this stuff. This is why we're going to keep doing this. You'll get better insights. All right, Chipotle. What's going on with Chipotle? Same period of time. So here's Chipotle CFI. Chipotle generated $969 million worth of free cash flow. Over the 5 years, gross cash flow, $1.9 billion. Gross investment, $900 million. 48% reinvested rate, generating $970 million of free cash flow, no acquisitions. Their reinvested rate, 50, 39, 58, 48, 47, 48, with the exception of 1 year, pretty consistent. And much higher levels of reinvestment than McDonald's. Matter of fact, if you look at CapEx to depreciation, consistently spending a lot more on CapEx than depreciation. So this goes back to the industry. 2014, McDonald's slashed their CapEx. Chipotle didn't. All right. So again, this reinforces this isn't an industry issue. Chipotle's still growing. They expect to sell more. McDonald's does not. This is where they're starting to diverge. Now, continuing on. What did they do with the $970 million? Well, they ended up with CFI of 140. So obviously they did something in the non-operating case. They put basically $437 million, 436.7 into excess cash. They basically increased their savings account, and they put another $400 million into non-operating assets. So think about this. Chipotle is not only making more money, they're funding all of their growth internally with free cash flow, and they still have money left to put in the bank, and they still have money left to give to shareholders. That's a great situation to be in financially. Now, what did they do with their debt? Clean balance sheet. There was no debt. So for the equity, they bought back $600 million worth of stock and issued $200 million. Okay. Now, here's the thing. What a lot of companies are starting to do, and I think my guess is Chipotle is probably doing this as well, is as employees were cashing in their stock options, companies would often redeem the stock options that the companies were issuing to basically be neutral to the common shareholders. Right? So I don't want to dilute you. So what I'm going to do is I'm going to buy back a similar amount of stock to what my employees are cashing in, so you're not being overly diluted. So if I had to guess, it's probably what Chipotle was doing. Right? But the point is, people aren't buying Chipotle because they're buying back a couple $100 million worth of stock. People are buying Chipotle because look at all this potential cash they're going to grow into over the future because their business is firing on all cylinders. But a completely different story than McDonald's. All right, so last item for today. What about Starbucks? So here is Starbucks CFI for the last 5 years. Take a look. Tell me what's going on. Again, you talk amongst yourselves first for about a minute or two.
So if there's a conversation is it between
Oh, really?
We finished the one.
Which would take off like 25
All right, so looking at Starbucks, sorry, it's the interest of time here. Free cash flow, how much? What's free cash flow? $30 billion. Gross cash flow? 35.4. Gross investment? 5.6. What's the reinvestment rate? 15. Investments in goodwill? Did they buy a lot of companies? Nothing that really impacted the cash flow. Now, what do you notice about the reinvestment rate? I know it averaged 15, but what do you notice about it over the 5 years? 11, -4, 13, 32, 25. It was really ramping up in the last couple of years. Do you remember the ROIC tree? What was happening in the ROIC tree in the last couple of years? Beyond the fact that invested capital sales was getting worse, but what was also happening in the last couple of years? Gross margin was dramatically improving. So that was the point. If you remember, Howard Schultz kind of left the business, turned it over. The guy screwed it up. There was way too many Starbucks in the U.S. Howard came in, fixed it, started slashing stores in the U.S., but grew stores outside the U.S. and changed the menu and raised price dramatically with the changed menu and then started opening stores again. So that you can actually see the progression of how that financially benefited them over time, and that was really the last couple of years. So what they do with the non-operating cash flow? How they get from 30 billion of free cash flow to 33 billion of CFI? What happened in the non-operating cash flow? How they increased it by 3 billion? What happened with the excess cash? Therefore, they raided the savings account to generate cash to pay out, sold $1 billion worth of non-operating assets. That's where the $3 billion came from. Gave $2.7 billion to interest to bondholders. What about the debt? Is that issue debt or pay off debt? It took out $16 billion in new debt. I'll give you a hint why. $16 billion of dividends, $30 billion of share repurchase. They gave $45 billion of cash to the investors. When did they give the cash out, though? This is an enterprising student in the last section picked up on this. What changed about this payout? When were they buying a lot of stock?
When they were at their lowest point.
And then now that they're buying less stock, why? Not saying they cut it completely, trade off between reinvestment and payout. Now that the business is making kick-ass margins and we're getting profitable growth, we don't need to buy back as much stock. Let's put it in the business and grow that positive spread and create more value that way. Why do we pay out stock? Because we're not growing a positive spread and we're better out with the payout rate. Link to the key value drivers. Homework 5, extra credit 1, 10 a.m., Monday. Individual assignments, make sure you do the 500-word write-up, including talking through numbers, explaining the assignments, and you just need the screenshot for extra credit 1. Make sure you match the numbers that I have. See everybody on Monday.